What if I told you silver is instant cheap by accident, and that a centuries-old ratio is quietly flashing one of the biggest wealth signals of our lifetime? David Morgan says the natural 10-to-1 gold-silver ratio is finally coming back, and if he's right, silver isn't just undervalued. It's set to explode in a way most investors are completely unprepared for. Welcome to Silver News, your trusted source for gold, silver, and precious metals insights. From daily price updates to expert-backed investment strategies, we break down the bullion market so you can stay informed, protected, and ahead of the curve. Let's get started. To understand why this is such a big deal, we need to start with the ratio itself. The gold-silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number has been historically extreme for much of the past decade, often hovering around 70, 80, or even higher. In moments of crisis, it has blown out beyond 100-to-1. That kind of imbalance is not normal when you zoom out across thousands of years of monetary history. For most of recorded civilization, the ratio sat much closer to 10-to-1 or 15-to-1. Ancient empires, medieval kingdoms, and early modern economies all recognized that silver was not some cheap afterthought. It was money. Real money, and it was scarce. David Morgan has spent over 40 years studying the silver market, and his core argument is simple but powerful. Silver is fundamentally undervalued relative to gold, and the market has been suppressing its true price through paper contracts, futures markets, and financial engineering. According to Morgan, the physical reality of silver is now colliding with this paper illusion. Mines are struggling to increase production. Above-ground inventories are shrinking. Industrial demand is exploding, especially from solar panels, electric vehicles, medical technology, and advanced electronics. At the same time, investors are slowly waking up to the fact that silver is not just an industrial metal. It's a monetary metal with a long memory. What makes this moment different is the convergence of forces hitting the market all at once. On one side, you have central banks printing currency at levels never seen before. Trillions of dollars, euros, yen, and pounds have been created in just a few years. That money doesn't disappear. It leaks into asset markets, into consumer prices, and into hard assets that cannot be printed. Gold has already responded to this reality by pushing toward new highs. Silver, historically, lags behind gold at first. But when it moves, it tends to move fast and violently. Morgan argues that once the gold-silver ratio begins to collapse, it doesn't do so slowly. It snaps. When confidence in paper markets starts to break, silver's smaller market size becomes a critical factor. There simply isn't enough physical silver available to meet sudden investment demand. If even a small percentage of gold investors rotate into silver, the price impact could be enormous. This is where the 10-to-1 ratio becomes more than just a historical curiosity. It becomes a target, or at least a gravitational pull. Critics often say, that ratio will never return. The world has changed, but Morgan pushes back hard on that idea. Yes, the world has changed, but physics hasn't. Silver is still consumed in industrial processes and rarely recycled efficiently. Unlike gold, which mostly sits in vaults and jewelry boxes, silver is used up. Every smartphone, solar panel, and electric vehicle locks silver away in tiny amounts that are economically impossible to recover at scale. Over time, this creates a structural supply deficit. The world needs more silver than it produces, and that gap has been filled by drawing down stockpiles. Those stockpiles are not infinite. Another overlooked factor is the psychology of investors. Silver is famous for being boring until suddenly it isn't. In past bull markets, silver has delivered gains that made gold look tame by comparison. In the late 1970s, silver surged multiple times faster than gold. In 2011, it again outperformed dramatically in a short window. Morgan believes the next move could be even more intense, not because silver is magical, but because the financial system is far more leveraged and fragile than it was in previous cycles. There's also a geopolitical angle that's impossible to ignore. Trust in governments, central banks, and financial institutions is eroding. Sanctions, frozen assets, and currency weaponization have forced countries and individuals alike to rethink what real wealth looks like. Gold has been the primary beneficiary so far, especially among central banks. But silver historically follows gold's lead, often with a delay. When that delay ends, the catch-up can be brutal for anyone who is unprepared. Morgan is careful not to promise exact price targets, but he does emphasize ratios over dollar values. If gold continues to rise in a world drowning in debt and currency creation, and if the ratio compresses even partway toward its historical norm, silver prices at today's levels make very little sense. A move from 80 to 1 to 40 to 1 would already imply a massive revaluation. A move toward 20 to 1 or even 10 to 1 would be transformative. What makes this story even more compelling is how few people are paying attention. Mainstream media rarely talks about silver unless it is crashing or being mocked as a meme trade. Meanwhile, industrial users quietly secure long-term supply agreements, and informed investors steadily accumulate physical metal. This disconnect between perception and reality is exactly what creates outsized opportunities. By the time silver becomes a headline story, much of the move may already be over. This isn't about hype or get-rich-quick fantasies. David Morgan's message is rooted in fundamentals, history, and math. Silver is scarce, demand is rising, supply is constrained. The financial system is unstable, and the gold-silver ratio is stretched to levels that have historically preceded major reversals. When these elements align, markets don't move gently, they reset. So the big question isn't whether silver will move, but when. If Morgan is right, and if the ratio truly begins its journey back toward natural levels, silver could shock even seasoned investors. The window of opportunity may be far smaller than most people realize. Because when silver finally wakes up, it doesn't knock politely, it explodes. Thanks for watching Silver News. If you found value, hit the like button, subscribe, and turn on notifications. Stay informed, stay invested, and we'll see you in the next update on gold, silver, and the bullion markets.